Hello, everyone. Welcome back to another webinar that we are so excited to host and share with you today. I am joined by the most wonderful team at Blue Sky Climate, and today we are going to be doing a bit of a refresher, a Q&A, and really helping people understand now that we've had some time to noodle on these California's climate disclosure laws, how can you meet the upcoming deadlines? So here we go. All right. With us today, me, of course, from Carbonhound, and then we have Lisa and Susan, like I said, from Blue Sky Climate reporting. And we're really excited to kind of dive into it today. So we'll leave our contact information at the end here. If you have any questions, concerns, please don't hesitate to reach out to us. And we're really looking forward to sharing some expertise with you today. All right. I'm going to pass the proverbial microphone over to Lisa here, who's going to give us a brief overview of the disclosure laws.
Thank you, Lauren. It's great to be here with you today. We've got a lot of information to cover, but before we jump in, it's important to mention that we'll be providing information today based on past and recent updates from CARB. So they're the agency in charge of rolling out these new laws in California. CARB stands, for any of you who love a good acronym, CARB stands for California Air Resources Board. And you'll see during our presentation today that we continue to expect more updates and clarifications from them in the weeks ahead. We strongly encourage you to subscribe directly to CARB. And of course, you're welcome to reach out to either Lauren at Carbonhound or Susan and myself from Blue Sky Climate. And we're happy to interpret those updates for you as they apply to your company. Okay, so Lauren, without further ado, let's jump in. Next slide, please. Okay, great. So today's focus is 261, SB 261, Greenhouse Gas Emissions Disclosure, and SB 253, Climate-Related Financial Risks Disclosure. We should start by saying that California made history in 2023 as the first state to pass mandatory climate disclosure laws. These are known collectively as the California Climate Accountability Package. They include SB 253, which requires companies, as the title refers to disclose their greenhouse gas emissions, and SB 261, which focuses on all of the climate-related financial risks that are applicable to that company, those material risks. Governor Newsom signed these into law in October 2023, and he did note, however, that there were some concerns around cost and timing. So since then, these laws have faced some legal challenges. However, CARB has confirmed earlier this month that the statutory reporting deadlines, which is of course the big thing that everyone is focused on, remain very much in place. And companies must still plan to publish their first SB 261 climate risk report by January 1st, 2026, and their first SB 253 emissions disclosure by June 30th of 2026. So just looking at the side here, you can see that these are the first mandatory climate reporting laws in the United States, and they affect all companies meeting the minimum revenue thresholds and doing business in California, regardless of where they are headquartered. We're going to talk about that in just a minute in a bit more detail. CARB, just to let you know, there will be some fees involved in submitting your reports. So CARB has proposed that the fees for SB 253 is roughly $3,100 and $1,400 for SB 261. So even though rulemaking has been delayed, the climate reporting clock is still ticking. Companies should continue building their data systems and governance processes now to really stay ready when those final rules take effect. And again, we're watching those updates from CARB on a daily basis, and we certainly do share those as they're made available. So in short, the laws are in place, the timelines are firm, and companies should be preparing now. Okay, next slide, please, Lauren. So who exactly needs to comply with these new laws? CARB is still finalizing its definition of doing business in California, but here's what we know so far. First, annual revenue. Companies with over 500 million in annual revenue doing business in California will fall under SB 261. Companies with over 1 billion in annual revenue doing business in California will also need to comply with SB 253. So just the nuance there, if you're above 1 billion, you will have to report under both of these laws. CARB is still finalizing its definition, as we mentioned, of doing business in California, but it is expected to align closely with the state's tax code, meaning companies with significant sales, property, or payroll in the state should assume they'll be in scope. Exemptions are likely to include nonprofits, government agencies, and companies whose only California presence is through remote workers. Just last month, CARB published a list of more than 4,000 companies that they've already identified as being in scope for reporting, but they're being very clear here. If you look and you don't see your company's name on that list, do not assume that you're off the hook. If you do meet the requirement, those that I've just highlighted here, and you do not see your company on the list, you need to assume you'll be in scope and that you'll need to report. Okay, next slide, please, Lauren. Another important point of consideration is regarding parent companies and subsidiaries. The guidance from CARB is if a parent company and its subsidiary together exceed the annual revenue threshold and they meet the doing business in California test, the parent company can file one report covering all entities. So subsidiaries only need to file separately if they individually exceed the threshold and the parent company does not consolidate reporting. So CARB is encouraging one report per corporate family, obviously to avoid duplicate filings. So although we're still waiting for CARB's final confirmation, the working assumption is that if your company meets the thresholds, even without a physical office or formal operations in California, so regardless of where you are headquartered, you should expect to report again under one or both of these laws coming into effect. Okay, so next slide, please. Let's look at these two new California disclosure laws a little bit more in depth. Again, we're going to keep talking about those revenue thresholds because really, really important. That's sort of the first litmus test. So again, SB 261, climate-related risk reporting. This law applies to companies, again, over 500 million doing business in California. And under this SB 261, companies are required to disclose their climate-related financial risks, both physical risks like extreme weather events and transition risks like policy or market changes. These disclosures must be reported to the state and also published on the company's website. So that's an important nuance. Once the report is done, you post it to the website, the URL is submitted to CARB. So that's the mechanism there. And importantly, 261 is, or SB 261 is aligned with TCFD and IFRS S2, so companies can lean on global frameworks they may already be familiar with. The reporting is primarily qualitative, but, and this is critical, if a company makes specific climate or emission reduction claims, those must be third-party verified under Clause 5 of the law. So we're going to talk about sort of limited assurance and what that looks like. Susan will speak to that in a few minutes. So even though obtaining assurance for SB 261 isn't front and center with this law, it's indeed there, and the companies are now, obviously needing to be aware of this and to make those plans to verify their publicly disclosed claims. Now let's just move to SB 253, so greenhouse gas emissions disclosures. This one applies to larger companies, so those doing more than $1 billion in revenue anywhere and with operations or doing business in California. It's focused on greenhouse gas emissions reporting, and for the first compliance cycle, so those reports due in 2026, companies only need to disclose for this, again, first reporting year, scope 1 and 2. But starting in 2027, Scope 3 emissions, so those with supply chain and on the customer use side, will also need to be disclosed. So what we're advising our clients, and Susan, really speaks to this a lot with our clients, as I know Carbonhound does, now is the time to start thinking about Scope 3, very important. However, for this first reporting year, CARB will be looking specifically for your Scope 1 and Scope 2 emission disclosures. These inventories must be prepared in line with the GHG protocol, which is the global standard for emissions accounting. So third-party assurance is required under this law, and again, Susan will speak to that in just a few minutes. So, in summary, 261 focuses on climate-related financial risks. SB 253 requires greenhouse gas emissions reporting with third-party assurance disclosures. Those are the big things that you need to remember here. And together, these are the new baseline for climate reporting in California. I mentioned that there have been, 4,000, a couple of thousand more, depending on which legislation you're looking at, which law you're looking at. There are estimates of, above 8,000 companies will be impacted when folks are really taking a look at the requirements. So it's not insignificant, the number of companies that are going to be affected. So let's go to the next slide, please, Lauren. We are asked this question frequently by companies who are inquiring. And yes, there are penalties. Let's have a look at what happens if a company that's in scope does not report. So for SB 261, penalties can be up to $50,000 per company per year. For SB 253, penalties can be up to $500,000 per company per year. It's important to note that CARB's emphasized a good faith effort approach for this initial 2026 reporting cycle. And so that means that they are really looking for companies to show that they are making real progress, that they're getting organized, that they're starting to look at their disclosures, they're building capacity, they're looking at internal controls, that they're having these very important discussions internally and with their supply chain. And so they're going to be looking at that activity rather than expecting perfection right out of the gate. So the takeaway here is the state is serious. Deadlines are, as stated, the penalties are real, both from a financial perspective, but also from a reputational standpoint, which is really key. So if a company, really wants to show that good faith with both the state and your stakeholders, now is the time to take action. So, Lauren, let's move to the next slide, please. Let's take a closer look at how SB 253 will be phased in for the first submission. So that is due June 30th, 2026. Companies will be required to report their Scope 1 and Scope 2 emissions for the first reporting year. So those are 2025 emissions. Starting in 2027, companies will also need to include Scope 3, which I mentioned previously. So those direct, indirect emissions across the supply chain and product use. So that means that companies should already be thinking about how to map and collect Scope 3, even if it's not required, as we mentioned in the first year. So CARB has also talked about assurance. Again, I won't say too much about this. Susan will be going into that in great detail. So Scope 1 and 2 will require limited assurance, and by 23, reasonable assurance, which Susan will explain more. And so for Scope 3, limited assurance will also be required by 2030. So this is a gradual step-up process. They want people to understand what this looks like for their company, and they're giving companies the required time to get themselves organized and to get everything in place so that by the time that the reporting is required, that companies will be well in hand with the reports. The CARB reporting portal will be open December 1st. That's how they are going to be accepting these reports. And they will close, importantly, on June 30th. So that is the date. Disclosures must be submitted annually for SB 253, and they may also be made available, as I mentioned previously, on the CARB portal and posted on the reporting company's website. So finally, companies are expected to retain detailed records to support their disclosure and the assurance process. So good documentation practices will be essential. So in short, SB 253 begins with Scope 1 and 2, but quickly expands to Scope 3, and over time, the assurance requirements will also get more rigorous. So next slide, please, Lauren, and my last one before passing it over to you. So this is just a quick update. Recently, CARB released its first draft of the official GHG reporting template. So we've been waiting on this for a little bit. It's going to be linked directly to this presentation that will be shared following the webinar. So please do click on it and have a look at what that looks like. The draft template gives an early view of how they expect companies to structure and report their scope 1 and 2 emissions data, again, under SB 253. It's still in draft form, and a second version is expected later this year following public feedback and pilot submissions. But again, it's something important for you to be aware of and to have a look at to see what the expectations look like. And so the best, sort of early advice is now is the time. Susan will be talking a little bit about timelines before we end today's call so that you understand what that looks like. And I think what I'll do now is pass the mic over to Lauren and learn a little bit more about 253.
Awesome. Thank you so much. I'm sure if you're sitting there and you've already been measuring your emissions for a long time, you're thinking, gee, not another form, not another Excel sheet that I have to fill out with the same data that I've been tracking for years. And if you've never measured your gas emissions as an organization, you're thinking, I have no idea what this means or what you're talking about. So just want to walk through at a higher level when we talk about SB 253, so related to emissions reporting, what does that actually mean? So there's 3 scopes for greenhouse gas emissions. And again, this is defined by the Greenhouse Gas Protocol, which is that international standard. And scope 1 and 2 are the pieces that are going to be most important to work on right now because of that phased in approach. Scope 1 for your company looks at the emissions that come from the owned facilities and assets that produce direct emissions. So that would be things like a boiler that you have on site if maybe you're a manufacturing facility that makes granola. That might come from your boilers. Another scope 1 emission would also be the gas that you use to fuel your delivery trucks or your propane forklifts and things like that. It might also be the emissions that come from the refrigerants. So you've got refrigerants, you're cooling your ingredients, and a bit of that leakage would be measured as part of your fugitive emissions. So that's stuff that happens on your site, in your control, directly from your assets. So that's scope 1. Scope 2, these are your indirect emissions. And really what we're looking at here is your purchased electricity. So you have control over how much electricity you use to make your granola, but you don't have control over how it's made because that's, the utility provider or the state or whoever it is that's doing that. So scope 2 is a measure of the emissions that come from the electricity, heating and cooling that you use as an organization across all of your locations. That's what to focus on in the short term. Scope 3 is a whole other can of worms, and it, for most companies, is actually where the vast majority of your impact lies and where the vast majority of your emissions as a company come from, because it takes into consideration everything in your value chain. We are going to, of course, make sure we capture only what's material. So this is also outlined in the Greenhouse Gas Protocol and the ISO standard that says let's focus on what really matters as a company, but we are talking about everything you purchase as an organization, what you create and where it comes from, where you send your letters, where you send your products. It takes into consideration the business travel that's done by employees, things like employee commuting, so how everyone gets to work every day. And there's 15 categories that are outlined within the Greenhouse Gas Protocol that help companies identify all the different parts of their business that are going to be relevant or might be relevant to assess your greenhouse gas footprint for scope 3. For all of you, financial institutions or organizations that own a lot of, not physical assets, but have a lot of investments, there's also financed and insured emissions. And so this is taking into consideration what are the emissions associated with your financial activities. So if you're a bank and you loan lots of money and you've got lots of mortgages or, capital kind of loans, what are the emissions associated with those as well? So as you can imagine, it starts to get a little bit hairy and it starts to involve your value chain. So, this is where you're actually having to understand and speak with and engage your suppliers, customers, employees, stakeholders. Um, it's as Lisa said, the deadlines are graduated on a timeline basis because it takes a lot of time to get this right and to work on it. So even though scope 3 isn't going to be required right out the gate, because of what a project it is, it can often take companies years to really get a comprehensive look at their scope 3 emissions. So recommendation is always, even if you're not disclosing it, start thinking about it, start looking at what's important, start talking to either a consulting team or to a software provider or to your in-house expert about what you're doing about scope 3 emissions and tracking. There's along with the greenhouse gas protocol, or part of the greenhouse gas is outlining how you actually measure this. So we've outlined the different scopes and then the categories within scope 3. But to actually get a number, your greenhouse gas emissions are going to be measured in CO2e, or carbon dioxide equivalent. And how you get that number is by taking operational data from your business. So you're purchasing a whole bunch of flour to make your granola, perhaps. So you're taking that usage data of what you purchase and what you use. You're multiplying it by an emission factor, and those can be provided by government agencies, scientific studies that try to assess the impact from a greenhouse gas perspective of that usage item. And out of that, you get your carbon dioxide equivalent. So you're going to apply that calculation across your entire business, your procurement, your accounting, your utilities, everything, and generate a report. So you might use this data for an annual ESG or sustainability report. You might include this as part of a CDP submission, or you might set science-based targets. There's lots of different ways that you would use this emissions data. And one of them, of course, is going to be SB 253. Importantly, we don't want this to just be data for data's sake. The reason that California cares about this and the reason that we care about this is because understanding your emissions can help you identify ways to improve and reduce and optimize your business, both from an operational standpoint as well as an emissions perspective. So we're going to help you identify, okay, where are the hotspots? What is really contributing to your emissions? Is it a particular ingredient? Is it a particular delivery method of transportation? Is it a particular site within your, hundreds of sites? And how can we help you make your business more sustainable from an environmental perspective and also from an operational and cost perspective by looking at your organization through the lens of sustainability? So we're not looking at just reducing, we're also looking to improve the data quality so you can make data informed decisions. And with all of this, after all of that, for the purposes of SB 253, you are going to need someone else to look at your data and provide assurance. So I will pass this off to our expert about assurance.
Great. Thank you so much, Lauren. Well, there's generally two types of greenhouse gas emissions verification or assurance processes. One is called limited assurance and the other reasonable. So taking a look at limited assurance, which is most important for us currently under SB 253 and possibly under SB 261. Limited assurance is a lower confidence of assurance process, meaning that the procedures include sampling, spot checks. It's a limited review of methodology, of organizational boundaries, controls implemented, and accompanies error logs and data validation mechanisms. Limited assurance can be performed virtually, and everything is written in a negative assurance statement, meaning the example here is nothing has been found to suggest material misstatement in this greenhouse gas inventory. So limited assurance is a shorter process and a less thorough process. And this is really following the same guidelines as financial auditing, where you have limited and reasonable assurance as well. We talked about SB 253 requiring, this is the greenhouse gas law, requiring scope 1, 2 limited assurance. So this is for the first go, this first disclosure, limited assurance is required for scope 1 and 2. SB 261 under clause 5, if you are making quantifiable reduction emissions claims, mitigation strategies, think anything with numbers and percentages, this also will require, under the state of California, assurance. So while 261 is a qualitative report, we'll get into in a little bit, if you are making quantitative claims in that report, they also must be assured. Reasonable assurance, the procedures are less sampling and more comprehensive in nature. Testing of data, testing of controls, looking at sources, stakeholder interviews, audit trails, and on-site checks. And this will be required under 253 by 2030. So something to think about for scope 1 and 2 only. Next slide, please. So CARB, the California Air Resources Board, the agency that is implementing both of these laws in the state of California, is very, very forthright in their recommendations for assurance, which is, and I quote, give yourself time for assurance. Assurance and the process is very thorough. That's the nature of an audit, obviously. So we're looking at generally 2 to 3 months for limited assurance. And given that there are upwards of possibly 8,000 companies needing to report, there are not enough assurance providers. So that said, processes for assurance and some of the frameworks that are being used, the state has mentioned ISO 14064-3, accountability standard, the IAASB standard, as well as the American Institute of Certified Public Accountants, AICPA standard. These are all proper assurance standards. So if you find an assurance provider, any one of these at this point in time will be fine. Assurance should be systematic. It should be independent, meaning that it is unbiased and objective in all conclusions. It needs to be very well documented. It needs to be responsible in terms of the assurance provider not also being the entity that is calculating your emissions, and impartial, obviously, with no conflicts of interest. Next slide. So SB 261, we promised you a closer look on the financial climate-related risks disclosure. So this is a biannual reporting, different from SB 253. SB 253, there is going to be a template that is brushed off, as Lauren and Lisa had mentioned earlier. We have a draft template already. It is mostly numbers and very simple to report once your greenhouse gas emissions have been calculated. SB 261, unfortunately, at this point in time, is not quite as clear-cut. It is a qualitative report following the standards of either TCFD 2017, which those standards, for those of you who geek out on this type of thing, have since been folded into the IFRS Standard 2. So in this report, we are looking at, you need to follow as a company one of these two frameworks, most likely IFRS Standard 2 going forward. And that standard includes 4 pillars. So those pillars are governance, strategy, risk management, and your company's metrics and targets surrounding climate. The report preparation needs to describe your material climate-related financial risks. It should include a climate scenario analysis, as well as anything that is demonstrating your reduction and mitigation efforts. However, I say should because for this reporting period, and this is only verbal, we do not have written confirmation of this as of yet, but per our understanding of the workshops we have attended with CARB, they are not mandating a climate scenario analysis or quantifiable reduction targets for this first disclosure period. That being said, for our clients, we are offering this as an option, and 9 out of 10 have taken this option to go ahead and, just in case, get started on those two pieces of the report. And I'm happy to take questions on that because it's a little confusing at this point in time. Partially because the regulations have not fully been disclosed. So the regulations for both SB 253 and 261, if we haven't already said it, we should say it now, are in development currently with CARB. And that means that for Q1, by the end of Q1 2026, the regulations will be set in stone. So they'll be codified then. However, the statute for the laws, and for this law in particular, is indeed reporting by January 1st, 2026. That is why they're accepting what we call best faith effort in the first submission. So as long as your company follows the standards of IFRS Standard 2 and aligns itself with the pillars within that standard for your industry sector, a good place to look for industry sectors is SASB, SASB. They have over 100 industry sectors that are listed in their documentation. As long as you're looking at that and following these general frameworks, you should be more than prepared for best faith effort. The submission is either, well, actually both, on your company website, and then later when we get a specific portal link from CARB, we will then post your company's submission from your website, that link, to the CARB website as well. So this will validate both efforts for public-facing disclosure as well as state agency disclosure. Next slide. So the time is now for 261. If you have not yet started this reporting, we strongly suggest you do so. I know for our own calendar, we are looking at our very last potential slots for this, given that our goal for every report is to have it submitted on a company's website and to CARB through their portal, which will be made available in early December. So give yourself an ample amount of time for this. And the good news for you is that you can use 2024 data given the timing of this first disclosure. So if you've calculated your emissions for 2024, if you have governance and risk management documentation or any kind of relevant documentation that is dated 2024, that is all appropriate for the first disclosure. You could also start a climate scenario analysis if you choose to, as well as look at reduction and mitigation strategies. And remember, if you publish anything that is quantifiable going forward for 261 disclosures, you should also have that limited assurance put in place as well. Okay, so starting now, yes, this is October already. Moving quickly to November, the draft disclosure following governance strategy, risk management, metrics, and targets should be completed. You should be integrating any 2024 greenhouse gas emissions data, or if you're on a separate financial fiscal year, you may want to incorporate 2025 if that is appropriate for your organization. December is, we are looking at final CARB portal submission guidance. And then you should also be prepping your own website internally for this important disclosure for public-facing communications. And then by no later than January 1st, 2026. And of course, we recommend a few weeks prior because you never know with the portal, you never know with technology what might crash, what might not, and when. You should be publishing this 261 financial climate risk report to their portal and on your website. Next slide. So, yep, that's it. It is a lot to take into account, and we welcome any questions anyone in the room has. Just type them into chat, or we can even take them live if you would like. Thanks so much for your attention, and I'll turn it back over to Lauren for questions.
Awesome. Thank you so much. I can't express how helpful it is to have people who are able to break down what is a very confusing, rapidly evolving, and uncertain regulation law by two people who really care to really make this interesting and understandable for people who don't who for this is new for them. We have been getting lots of questions on an ongoing basis for people who are looking into these laws to see if it's going to be relevant to them, to understand what to do. And so I have a few sort of FAQs that I've been collecting that I would just love to get your opinions on because I really only know so much on the 253 side and on the greenhouse gas emission side. So, uh, one thing that's coming up a little bit is okay, imaginary company. I am 500 million in revenue, so SB 261 is relevant, but I'm not at that 1 billion mark. Do I still need to measure my greenhouse gas emissions?
That is a really good question. I'll take that one. Well, of course, I'm quite biased in this space because I think every company should be measuring their greenhouse gas emissions, minimally scope 1 and 2 to start, and scope 3 category by category, and layering on as many material categories as they can in subsequent years. However, in regards to 261, a lot of companies that we have been consulting with have never published any kind of financial risk report and really, frankly, don't know what it is, which is super understandable.
Mm-hmm.
That said, because they don't have a lot of data on governance or their own risk management strategies or anything to do with climate at all, what we've recommended is they do a baseline 2024 greenhouse gas emissions inventory so that they have something to publish in the metrics and targets section.
Right. Okay. That's really helpful. And it's also really important just to emphasize again that 2024 data is accepted. So I think a lot of people have also been scrambling and saying, how am I supposed to report on this information if the year hasn't even ended and I'm supposed to report on January 1st? And so, yeah, anything to sort of ease the stress on that side is really nice too. Okay. Another question. Okay. If I am not yet required to do this disclosure because I'm not at that revenue threshold, um, what can I be doing if I am either a compliance director at an organization or a sustainability director? What can I be doing ahead of time so that next year, say, when I do meet that threshold, I'm ready? So, what are the steps that people can take if they're not quite there yet?
So I can jump in here. There's a famous saying, when is the best time to plant a tree? And it was, yesterday, right? So just take that first step. We know that this is coming. We know that there is some, again, leniency in this first year, but this is absolutely where business is headed. And, I know, Susan and I had the opportunity to be in New York Climate Week. And regardless of what's happening from a regulatory perspective, whether it be North America, Europe, other jurisdictions, companies are already making the connection between climate-related risks and exposures, greenhouse gas emissions, sustainability, sustainable business practices. They're already seeing it through the lens of value generation, climate resiliency, business resiliency. And so we're really seeing that companies no longer need to understand why. They get it. They're seeing it. It's more, the how, what next. And so this is where we're really excited. And I know, Lauren, the great folks at Carbonhound as well. So Blue Sky Climate, we're really excited because this is really prompting those companies that maybe were, just on the verge or maybe thinking not quite us yet. It's really, for various reasons. We know regulatory is, usually that first step towards getting these conversations started. And so when Susan and I have these calls with our potential clients, they're actually quite shocked after we have a couple of discussions with them or even ask a couple of questions. They're actually quite shocked that there's more that they can report than what they actually think they can. They're already having conversations, maybe informally, maybe maybe not at the board level, but maybe at the executive leadership team level. Certainly within business units, on things that are applicable and appropriate to include in specifically the SB 261 report. So that's that governance piece, that's that strategy piece. So once we start to ask some very pointed questions and they start to think, well, yes, we are actually doing that, you can sort of see that they are really getting excited about what this means for them. And it's really that very first conversation. We see this quite a lot with the clients that we're working with, and getting their leaderships team together and really looking at, say, for example, for the first time, climate related risks and opportunities. The conversations that are really great, because not only are they talking about it potentially for the first time officially, but they're seeing where their thoughts converge and when their thoughts diverge. And that just means a really meaningful conversation that within very short order pulls into business planning, pulls into strategic operations conversations and discussions that go into next year, that sort of year 2, year 3. And so this is a really foundational piece. It comes in the form of California's climate laws, but there's a lot of benefit that our clients are seeing right out of the gate beyond just that regulatory compliance requirement. And that's what I think gives Susan and I a lot of pleasure and satisfaction in being able to sort of help them see that this is actually something that they'll be bringing into their organization in a really meaningful way, a lot faster than they had even assumed. So I hope that answers the question.
Yeah, I think it's if you work in sustainability, you know it to be true, but building a business that is sustainable for the environment is also building a business that is sustainable to be a successful business over time. And this is just a different way of looking at your business that can help you be successful and robust, and make sure that you're really building for the future here. Um, Another question that I wanted to make sure we just clarified for Susan, can you help us understand and maybe clarify the timelines for SB 253 reporting specifically, and then what year's data is required for SB 253 versus 261?
Yeah, so 253, the submission deadline has been pushed to June 30th, 2026, meaning that they are emphasizing and requiring 2025 data. So unlike 261, where you can use 2024 data, again, 261 due January 1st by January 1st, 253 has been pushed out 6 months. It will continue to be due at the end of June each year. And for that, we'll be looking at the preceding year. So most likely for most companies on a January to December or February to January fiscal year, they're going to need to wait until the beginning of next year to gather all of their 2025 raw data so that they can calculate their emissions. I guess the difference might be if you are a company that runs on a different type of fiscal year. For example, we have a client that's running September 1st through August 31st. Then, they're already calculating their emissions, their 2025 emissions, because of the way their fiscal year runs. So CARB has said that you can align it with your fiscal year, or you can align it with a calendar year. Most companies are choosing to align it with their financial reporting, so aligned with a fiscal year. But the key piece is it must include 2025 data for June 30th, 2026 submission.
Got it. Okay, that's super helpful. And just a quick note and call out, as everybody knows, reporting season and gathering all this data can take a really long time. And so, for emissions measurement specifically, something to think about is what cadence are you collecting this data, and how can you make sure that you're not late on that report because you're asking for all of this data at the end of the year. So, at Carbonhound, for example, we use software to collect this data on an ongoing monthly basis. So as soon as your data is coming in, we are converting it to emissions in that moment. So at the end of the year, you don't get overwhelmed with a process of having to backfill. So just something to think about when you're looking at ways of kind of understanding this for yourselves to use and also to report.
Lauren, can
Yeah.
I just hop in here? I was thinking when you were talking about, sort of the cadence of collecting data, I think that's one of the advantages of SB 261 as well, is that part of the requirement is really looking at documentation, looking at internal controls. So it is a really great way of, I'll say, getting your house in order so that it's a heavy lift, this first reporting cycle for sure, but then it becomes just implementing it for following reporting cycles. And that does apply as well to SB 253. So, we look at how are they collecting their GHG emissions? What does that look like? That's part of the reporting process for SB 261 through the metrics section, but it does benefit going forward how you're going to be pulling that data together. And so it's I think a really nice benefit to SB 253 if you're above the 1 billion revenue threshold and you are reporting for both. SB 261 will get you in a really good position for how to just continue, with that reporting collection processes going forward.
Yeah. Even just having somebody else who's gone through this before with another company to help you figure out those internal processes of collecting data and getting the right people in the room to understand is a huge benefit for sure. Okay, well, if there's no other questions, and Susan, there's nothing else to add on your side, I know you always are so on top of it, and I love it. But if that's the end here, I just wanted to point out that we do have other types of resources depending on how you like to learn. So we have a one pager that gives you the highlights. We've got a landing page that goes into detail with some of these FAQs, these deadlines, and of course, the opportunity to reach out to anybody here to talk to us. And if you have specific questions about your company, please don't hesitate to reach out. I know we emphasize timeline and how you're kind of running out of time, but we are here to help you meet that deadline. So don't hesitate to reach out. Let us know if you'd like that one pager. We'll send it, of course, to all of the registrants anyways. And yeah, can't wait to see you again at another one of these webinars. Thank you so much to Lisa and Susan for joining us today. All right. Bye,
Thank you.
everyone.
Thanks. Bye, everyone. Thank you.